All right, people, no messing about. Morgan, my man, welcome back. We're getting our hands dirty today with some proper old-school market plumbing. Forget crypto for a sec. Break it down for me. Contango and Backwardation. Sound like a couple of villains from a Dickens novel. What are they?
Save, Chris. Yeah, time to swap your JPEGs for barrels. Look, it's dead simple when you boil it down.
Okay.
It's all about the relationship between the price of something right now, that's the spot price, and the price for getting it delivered in the future, the futures price.
Spot is now, futures is later. I'm with you.
Exactly. So Contango, that's when the futures price is higher than the spot price.
Right. Higher.
Right? If you plot it on a graph, the curve slopes upwards. Imagine oil is $80 a barrel today, but the contract to get it delivered in 6 months is, say, $85. That market is in Contango.
Right, so you're paying a fiver more to get it later.
Why would you do that? Feels like you're getting ripped off. Think of it as a service charge. It's called the cost of carry.
Right.
I mean, if you buy that oil today, you can't just park it outside your flat. You've got to pay for a massive storage tank.
Okay.
You've got to insure it in case it goes up in flames. All those costs, storage, insurance, financing, they get baked into that future price.
Got it. So Contango is the well-supplied, lazy market. You pay a premium for someone else to hold the bag or the barrel for you. So what's its evil twin, backwardation?
Backwardation is the opposite. And this is where the real alpha is.
Oh, yeah?
It's when the futures price is lower than the spot price. The curve slopes downwards. It's inverted. So now oil today might be $90, but the contract for 6 months' time is only $85.
Hold up. Now it's cheaper in the future. What's the catch?
The catch is that people are desperate for it right now.
Right.
A war has kicked off. A hurricane is shutting down refineries. A key pipeline has been sabotaged. The market is screaming, I will pay a premium to have that oil today. I cannot wait 6 months.
Wow.
That premium you pay for having it now is called the convenience yield. Backwardation means the market is tight. It's a market in a panic.
Okay, that makes perfect sense. Contango is lazy, backwardation is panicked. So this isn't just nerdy chart stuff.
No.
It's a direct signal from the heart of the global economy.
That's the magic of it. It's one of the purest economic indicators you can find.
Really?
Forget what analysts are saying. If you see a major commodity like copper or oil flip into deep backwardation, that's a massive flashing red light that real-world supply is getting squeezed. It's an X-ray of the market's guts. So how did the big players trade this? I'm talking about, the hedge funds, the big commodity houses. Right. So in a contango market, they pull off a classic move called cash and carry arbitrage.
Okay.
It's beautiful in its simplicity. They buy the physical commodity at the cheaper spot price, say $80 for a barrel of oil.
Right.
At the exact same time, they sell a futures contract for delivery in 6 months at $85. Then they do the physical bit. They rent a massive oil tanker, fill it up, and just park it on the ocean.
You're kidding me. They literally just fill up a boat with millions of barrels and let it bob around?
100%. It's floating storage. As long as the total cost of renting that tanker, paying the crew and insuring the cargo is less than that $5 spread between the spot and futures price,
Yeah.
it's a virtually risk-free profit. We saw this on a biblical scale during the COVID crash in 2020.
Yeah, when the oil price went negative.
That was a super contango. Demand vanished overnight, but the oil just kept coming.
Wow.
Every storage tank on the planet was full. The spot price went negative because people would physically pay you to take their oil. The contango was so massive that the big trading houses who had access to storage made an absolute killing.
Insane.
So that's the contango play. What about backwardation?
You said that's where the action is.
Right. This is the holy grail for long-term commodity funds. It's called generating a positive roll yield.
Right.
So let's say you own a futures contract. As it nears expiration, you have to roll it into the next month's contract to maintain your position.
Okay.
In backwardation, that expiring contract you're selling is expensive and the new one you're buying is cheaper. So you sell high and buy low, month after month. It's like collecting a dividend just for being in the market.
So you're literally making money even if the price of oil is just, moving sideways.
Precisely. It's a structural return built into the market. But on the flip side, this is why many commodity ETFs can be a death trap for retail investors.
Go on. How's that?
Well, If a market is stuck in contango for years, which oil often is, that ETF has to perform the opposite of a positive roll.
It's constantly forced to sell the cheap expiring contract and buy the more expensive next month contract.
That steady loss is called roll decay or a negative roll yield. So it's why you can see the spot price of oil go up 10% in a year, but the popular oil ETF is flat or even down. It gets eaten alive by the structure.
Is that a proper trap? People on Robinhood think they're buying oil.
Yeah.
And they're actually just buying a ticket to get bled dry by the roll.
It's not a tax. It's just the price of admission if you don't understand the plumbing.
Right.
You're not buying a barrel of oil, you're buying a derivative whose performance is shackled to the shape of the futures curve.
Okay, let me translate this into my world. Contango is basically like when the funding rate on a perpetual swap is positive, you cost you money to hold a long position because everyone's bullish. And backwardation is like a negative funding rate where shorts are paying longs and you get paid to hold.
It's a solid analogy. The cost of carrying commodities, it functions like your funding rate.
Okay.
The crucial difference, though, is that this is driven by raw physical reality. You can't just mint more oil if a refinery explodes.
No.
You can't just code more wheat into existence during a drought. That's what makes it so powerful.
All right, you've sold me. It's not as boring as I thought. So, for the listeners at home who don't have a super tanker handy, what's a dead simple way to remember this?
Easy. Think of concert tickets. A last-minute ticket to see a sold-out band tonight, that's your spot price. Ridiculously expensive. The market is in backwardation.
Okay, yeah.
A ticket for the same band's show in 6 months, face value. That's your cheaper futures price. Simple.
Impressed. That clicked perfectly. So really learning to read the futures curve is like having a cheat code for global supply and demand.
It's one of the cleanest signals you'll ever get. It's not an opinion, it's not a forecast.
Wow.
It's the aggregated view of every major player in the world, priced in real time. It's pure signal.
Solid gold, mate. You almost make this old world financial stuff sound as exciting as a new Layer 1 protocol launch.
Almost, Chris. But this stuff actually runs the planet. Your protocols just run up my nan's electricity bill.
Cheeky bastard. All right, let's wrap it there. Proper masterclass. Now, here's a question we'd like you to think about. If you knew a major, non-perishable commodity was stuck in a deep and stable contango and you had £1 million in capital but couldn't buy a supertanker, how would you try to structure a trade to profit from it?